Welcome to TradeTheMBI.com. This is John. This report is for the 27th. Well, here we are. We're still in this stagnation. You can see we've had this complete reset of the shakeout indicator. Same thing happened over here as we got to our peak and we sort of consolidated a similar kind of thing. And what we're looking for next would be a turnaround in that shakeout. We're still dropping from DOC readings here, midterm buyers. It's the short-term buyers that have pretty much held this in place during what effectively is very weak reading from a daily. Key right here is that we never dip below the red line on the extreme, which means that there's pretty much very soft selling with regard to how it's taking place, which has been pretty modest. We'll see how earnings impact Amazon, and that was taking off yesterday. But NASDAQ has been way behind. And we can see that in the NQ futures here. It's been below the ABM green and just staying above it, which is a great pivot point. So it makes it easy from that standpoint. If we just go ahead and put it up there, you can see what the ABM green is at 6,057. But much bigger breakdown in the shakeout right here. The only nice feature was it had a reset of the steel. It just didn't get any support from your other buyers, and you can see when it does it all by itself, it can't sustain it. It needed that impetus to come from below, and then the surge of midterm buyers, and that to fill in the gap in between. When you don't see that happen, it's a problem. Euro took a big hit with the QE. Now we're getting closer to that range. That's going to put more downside pressure on the ES. We were in the 115.5 range. This big decline certainly gets us much closer to that normalized range, which is what we would expect. Looking at TLT, we can see big reduction in the, not big, I mean, just back to the bottoms. We've been seeing this continual decline. And expected, we're still looking to get down towards the 120, which would give us then a secondary target that's down around the 113 range. As it becomes clear that there's going to be a push towards inflation, higher rates, it's inevitable. You can't have the growth without it, unless there was, as some of us might suggest, unlimited slack in labor supply. Now, if that's the case, then you're not going to see the inflation, which is also going to be impacting gold. And this has been something that they don't realize. When they tell you that we're at full employment with, this tiny unemployment rate, if you're still able to acquire workers and it's not driving wages, that's an indication there was a huge slack and that they really weren't revealing it. It's sort of an obvious one to most of us who see the labor participation rates and know that there's this huge well of workers that are available. But this is political economics, which is different than actual real world economics. So you can see oil back at the top end, and that's another strong indication. You can get into the minutiae of supply and distribution, all these other things. But at the end of the day, overall demand is really what drives the general direction of price there, and that's really what we're looking for to see. And again, see gold suffering a little bit as it's recognized that we're still not seeing a spike upward in inflation because we haven't reached that critical mass yet. Now, will it come sometime in the early part of next year if things continue to go and tax reform takes place? Absolutely. But this is a long-term play anyway, so it's revisiting the dip below the red line. Not a surprise, the problem for it, it made a new dip below the red line, which just means that there's money's moving elsewhere to more active investments. And you could theoretically, with what you're seeing on treasuries and that, see another active run up for the market, which I know will cause people a lot of consternation, but money's got to go to work somewhere. You can't just let it sit because it never sleeps. So here I've shrunken down the 5K chart, and we can see several days going back here, but at the end of it, if you just sort of put your line right across the middle here, all you're getting is just a slight move above and below general average weighted price here, and it's just somewhere around that 25.60 range, and we just move a little below, a little above, and so there's like a effective consolidation taking place within that, and it's worth noting because I think that always gets missed out sometimes when we get into a consolidation. It's not breaking down And now you're starting to get people recognize there's really not an impetus to sell. There's no real new impetus to buy yet. Other than tax reform, I mean, people think that it's pre-baked into it, but not so much. I think that the potentials of it still have a strong catalyst for exciting the market for higher multiples, simply because of the potential for added growth, added inflation certainly impacts perception, and that's all the market really is perception. Real value is kind of an interesting thing, but the psychology is more important, and we get to see that in how the algos are operating and where the resets are, and you just got to take it from there, and that's all we can do with it. So that's the key component, to not overthink it and follow with what the money's doing. And when it gave us the nice little buy signal, you take them. That's all you can do. As always, look for me on the Skype chat, and trade well.